All right. So part three, hopefully this is our last part. All right. So stocks is just ownership in a company through shares that are traded on the market like the New York Stock Exchange or NASDAQ. Owners share in profits through something called dividends and usually paid out quarterly. Um, Quarterly just meaning 4 times a year. And that is if a company makes a profit or decides to share the profit. Or some companies, they're not making profit. Amazon, for a long time, because they were growing so much, they were taking all their profit and reinvesting it in their company and buying, warehouses and machines and robots and all sorts of different things to help them. They weren't, turning a profit. Um, but if you do find a more established company, they'll give you a certain percentage per share, and then that becomes cash and you can reinvest it. So it's a way to compound your interest. Okay. I enjoy buying stocks, and one of the things that I look for are dividends, right? So I want to be able to buy, let's say Ford. Ford is $10 a share, and they pay about, let's say, 10 cents per share. Okay. If I buy enough, shares of Ford, um, I think it's more than 10 cents per share, but I think it may be like more like 20%. But anyway, if every quarter they're paying 20% of shares. So if I bought 100 shares of Ford, and they're paying 20 cents per share, I can then take that money after a year and reinvest it and buy more Ford, and then I can increase the value. Okay. So if we take a stock like Amazon, and I did that, and every time they had a dividend or I just reinvested it back into the company, um, I could find myself pretty wealthy. Let's see if it loads here. I don't think it's gonna. Sorry. All right. But what I find and what I was going to kind of show here is that with Amazon, if I would have invested $100 in 1997, and I would have got about 4 shares of Amazon, that 4 shares, and I reinvested every time I earned a dividend or anything like that. Um, if I did that over time, my 4 shares would be something more like 400 shares, and I would have about $129,000, right? Um, but then if you take a company like GE, a very well established company, this isn't going to load either. Neither here nor there. GE's gone down over time. So if I put all my money, and that kind of shows the risk, right? So um, you're sharing in the profits, but then what happens is that to the supply and demand for those individual shares um, are kind of reflected in certain ways, right? So it's tough. It's a tough indicator, and actually we've seen the stock market during the COVID-19 crisis do well in certain sectors, and this is a very confusing thing. So it's important to kind of look at, all right, why is this company who's doing so poorly and not making any money? Why is their stock going up? Well, that's just because people are buying their shares, or people want their shares for whatever reason. And so it's one thing to kind of keep in mind that just because a stock has a high price tag does not necessarily make them a good investment. Okay. So keep that in mind. So stocks are pretty risky, but they've become super popular recently, especially this last year. They now have a lot of companies have uh, they have zero commission, which means that they aren't. Um, which means that you don't have to pay per share. It used to be if I wanted to buy some stock, I'd have to pay about $7. And before that, it was even more. But then a company called Robinhood made it 0% commissions. And then a lot of companies like TD Ameritrade, Charles Schwab have followed suit. So it's a pretty risky investment, but we can keep there. Again, we'll talk about bonds. We've talked about bonds a lot, but bonds are a pretty low risk investment. You're going to get that interest no matter what. So with the stock, you might earn really good interest. You might not earn very good interest, but a bond you're going to earn the interest that you say that you're going to get. So a bond is you can get government bonds, but you can also buy companies sometimes issue bonds if they want to build something or borrow money. The football field at Matamidi and Wildwood Elementary and any construction that you see are paid for by bonds. Okay, so what the school district does is they issue what is called a bond. People buy those bonds, and then the school district has to pay back the interest from those bonds. Very low risk, and they a lot of times, especially if you get older, you might actually buy more bonds and less stock. Okay. So mutual funds and index funds, and again, I haven't been good at getting these open, but kind of show this. Oh, come on, open up. It's not going to do it. Dang it. All right. Well, Google the Dow Jones Industrial. So a lot of times when you turn on the news and they say the Dow has increased or decreased, they're talking about the Dow Jones Industrial Average. And what the Dow Jones Industrial Average is, it's the 30 companies from diverse areas of the economy that the Dow Jones people decide to put on this index. Okay, so you can get on it or off of it, but it's 30 select companies, and they'll take companies off and on. So GE was replaced a little while ago by Walgreens. There are a couple Minnesota companies, 3M's on it, not Target, United Health Group's on it. And then the S&P 500 is the 50 largest companies in the United States. So a lot of people, what they'll do is to kind of lower their risk of investment, they'll invest in many different companies. And one very smart investment is to just buy an index. There's a very famous investor named Warren Buffett. He's the probably fourth richest man in the world. He would tell you, if he was giving you advice, is to buy index funds, which just means you're paying money to buy the S&P 500 or the Dow Jones, or there's other indexes out there as well. Okay, but a lot of times it shows the measurement when you see the little ticker and seeing how the stock market is doing, and you see that line go up. They're showing an index. They're not showing the whole stock market. They're just showing 30 companies or 500 companies. Okay. And then there's, investing, actually an interesting thing about it is that you have employer-based investments. So a lot of that 20% investing that you're going to be doing, you're not even going to think about it. So the employer is just going to take money out of your paycheck and put it towards an investment account. And what you have is that in some of these investment, your employer will match a certain percentage. So at school, we don't have, teachers don't have a 401k. We have something called a 403b. But the way that works is that I pay 3% of my paycheck into an account, and or 3 or 5, or it depends from company to company. But then the employer will also pay 3%. So they match. Okay. And then that goes into an account that earns interest. And you do that without even thinking about it. So 401ks you want to make sure that you max those out. So if they say we'll match 7%, you should put in 7% so that they'll match it. And it's the easiest way to invest, and you're not thinking about it. And so make sure you look at when you do get a job, what are those types of benefits that are out there. My wife and I do something, and a lot of people do. We have both of us have something called a Roth IRA, and we've also we've created these for our children too, because they can work for college saving as well. So. It's an individual retirement account. It's like a 401k. There's a significant tax benefit in doing this. The investment is pre-taxed, meaning that you don't pay federal taxes when you withdraw, as long as you are over 59 and a half. And only certain percentage or a certain amount is taxed. So any amount that I pay into it in any sort of IRA. So what happens, what I mean by that is this. If I put in $1,000 into this Roth IRA, when I pull out that $1,000, it's not going to be taxed. So in nowhere is it taxed when I put it in. It's not taxed when I take it out. The only thing that will start getting taxed is when I have to pull out from the interest that I earned. Okay, that's because that's income. But it's a good way to sort of shelter some of your revenue so that you don't pay taxes on it. There's limits and rules to a Roth IRA. But if you max out your Roth IRA, you can get a pretty good return in that. And you can set up a Roth IRA now, and it might be something to look into because it's pretty cheap and free for people your age. So a big thing to do when you are investing is to diversify. Okay, I'm just looking at my time here. All right, so what you're trying to do, and some of you have to look a little bit at what your risk is. The younger that you are, the more aggressive you can be. The older that you are, you want to be a little more conservative. Okay, so you can kind of look at if you're aggressive, you're putting a lot in stocks, okay, less in bonds. But if you're conservative and maybe you're getting close to retirement, you probably want to shift your money more towards bonds and less towards stocks because there's less risk. And so it all depends on how risk averse you are. And you want to make sure that you diversify your accounts. Don't just put everything in one stock, okay, because that can be a challenge. So if all your money is in bonds, you might be missing out on potential growth. If all your money is in stocks, you could lose much of your wealth in an economic downturn. So build a portfolio of balanced investments that changes as you get older. Aggressive when you're young and less aggressive when you're older is kind of a general rule of thumb. And then on Thursday, we're going to play a game. And I posted a link to that game. So we'll get together on Thursday and we'll play Build Your Own Stacks. Okay. And it's just a way for, it's kind of a 20-year span where everybody sees how much they can earn. All right. That's it.